In the second quarter of 2025, JPMorgan Chase set aside $428 million for loan loss reserves. Bank of America added $403 million. Wells Fargo increased provisions significantly. These aren't small numbers. These are massive defensive positions being built quietly while bank executives tell the public that everything is fine. The Federal Reserve's 2025 stress test projected $472 billion in total loan losses under a severe scenario. Of that, $157 billion would come from credit cards alone. Another $124 billion from commercial and industrial loans. The stress test scenario included approximately a 30% decline in commercial real estate prices, testing whether banks could survive such a catastrophe. They passed the stress test. All 22 major banks remained well capitalized, even under this hypothetical disaster scenario. The headlines said the banking system is resilient, that everything is under control, that there's nothing to worry about. But look at what they're actually doing. Not what they're saying, what they're doing. Banks appear to have sufficient reserves and adequate capital to manage adverse macroeconomic turmoil, according to Deloitte's banking outlook. Yet they keep building more reserves, keep preparing for losses, keep positioning defensively. According to a recent survey of banking professionals, recession woes are the top concern for bankers heading into 2026, with 45% identifying a recession or economic downturn as the issue with the most negative impact. Behind closed doors, bankers aren't optimistic. They're preparing for disaster. Why the disconnect? Because banks have access to data you don't see. Loan level performance, delinquency trends by sector, real-time default rates, internal stress models that go beyond regulatory requirements. And what that data is showing them is terrifying. Let me show you exactly what banks are seeing, why they're preparing so aggressively, and what they're not telling you about the meltdown coming in 2026. In 2020, banks adopted a new accounting standard called CECL, Current Expected Credit Losses. Under CECL, banks are required to set aside reserves for the lifetime expected losses of a loan at the time of origination, fundamentally altering how credit risk is accounted for. This changed everything. Under the old system, banks only reserved for losses when they became probable, meaning they could wait until borrowers started defaulting before setting money aside. It allowed banks to look more profitable in good times, then get crushed when recessions hit because they hadn't prepared. CECL forces banks to look ahead, to model what losses will look like over the entire life of their loan portfolio. Not just next quarter, not just next year, the entire duration. And when banks run those models right now, in late 2025, the numbers are ugly. Here's why CECL matters for understanding what's coming. When banks build loan loss reserves under CECL, they're not just covering losses they see today. They're covering losses they expect over the next 3, 5, sometimes 10 years, depending on the loan type. Those reserve builds reflect their internal forecasts about the economy, unemployment, default rates, and asset prices. And right now, those reserve builds are accelerating. Banks have been increasing reserves due to loan growth, especially credit card balances, and a modest deterioration in their macroeconomic outlook. Translation: their internal models are predicting trouble. The reserve increases hit bank earnings. Every dollar set aside for reserves is a dollar that doesn't flow to profits. Loan loss provisions reduce bank earnings, as the amount of provisions reported quarterly in the income statement is added to loan loss reserves in the balance sheet. Banks hate building reserves because it makes them look less profitable. They only do it when they have to, when their models force them to, when the data leaves no choice. Right now, they're building reserves aggressively. That tells you everything about what their internal models are forecasting. The stress test scenario that banks just passed included a 30% decline in commercial real estate prices. That sounds like a worst-case disaster scenario. Except it's not hypothetical, it's already happening in certain markets. Bank regulators have identified commercial real estate as a key risk to financial stability, particularly within the office subsector, with the Fed's stress test finding that significant stress could lead to around $80 billion in losses for the banking industry. Office buildings in San Francisco, New York, Chicago, and other major cities have seen valuations drop 40% to 60% already. Not in a stress test. In reality, right now, buildings that were worth $200 million in 2019 are trading for $80 million to $100 million in 2025. Some aren't trading at all because there are no buyers at any price. The problem isn't just office buildings, it's the $1 trillion refinancing wall. Over $1 trillion in commercial real estate loans mature in 2025 and 2026. These loans were originated at 3% interest rates when money was cheap. They need to refinance at 7% to 9% rates. Do the math. A building generating $10 million in annual rental income could service a $250 million loan at 3% interest. But at 8% interest, that same building can only support a $125 million loan. The building hasn't changed, the rental income hasn't changed, but the debt the building can support has been cut in half. What happens when the loan comes due? The owner tries to refinance. The bank says, we can only lend $125 million, but your loan is $250 million. You need to come up with $125 million in cash or we foreclose. Most owners can't come up with that kind of cash, so they default, hand the keys to the bank, and walk away. This is already happening. In mid-2023, South State Corp's provision of $38.4 million was reportedly driven by a change in the commercial real estate price index forecast, with the CFO saying the Florida-based lender is building loan loss reserves in the face of a possible recession. Banks are seeing the defaults accelerate and preparing accordingly. Who holds these loans? Regional banks. Banks with over $100 billion in assets have relatively small exposures to commercial real estate relative to their assets, raising the possibility that current stress test eligibility requirements may be understating the true risks. The big banks, JPMorgan, Bank of America, Wells Fargo, they have commercial real estate exposure, but it's manageable. A few percentage points of their total assets. Regional banks have 30%, sometimes 40% of their entire loan portfolio in commercial real estate. When those loans start defaulting, the losses will overwhelm their capital. We saw the preview in 2023. Silicon Valley Bank, Signature Bank, First Republic. 3 major regional bank failures in the span of months. And those failures happened before the commercial real estate crisis fully materialized. The real wave hits in 2025 and 2026. Banking regulators view any ratio of commercial real estate exposure over 300% as excessive, putting the bank at greater risk of failure. Many regional banks are well above this threshold. They're not just at risk, they're in the danger zone right now. Credit card delinquencies are rising, not dramatically, not panic-inducing, just steadily, quietly, month after month. And banks are watching these numbers with growing concern. Credit card loans grew 19% at JPMorgan Chase in the fourth quarter from a year earlier, while outstanding credit card balances at Bank of America were up 14%. This sounds positive until you understand what it means. Consumers are increasingly using credit cards to fund basic purchases. They're not borrowing for discretionary spending, they're borrowing for necessities. When you see credit card balances growing rapidly during an expansion, it signals financial stress. Households are running down savings, using credit to bridge gaps between income and expenses. This behavior precedes defaults. First, balances grow. Then delinquencies rise. Then charge-offs spike. The stress test projected $157 billion in credit card losses under the severe scenario, 1/3 of all projected losses, because credit cards are unsecured debt. When borrowers default, banks recover nothing. The entire balance becomes a loss. The subprime credit landscape is poised to change for the worse in 2026, with roughly 77% of survey respondents saying it is somewhat likely that subprime credit portfolios will continue their descent at a faster rate compared to prime credit portfolios. Subprime borrowers default first, their finances are most fragile. They have the least cushion. When economic stress hits, they're the first casualties. And the data shows subprime performance deteriorating now in late 2025, before recession has officially begun. The progression is predictable. Subprime defaults rise first. Banks tighten lending standards. Credit becomes harder to obtain. Prime borrowers who lose jobs or face income reduction can't access credit. Prime delinquencies start rising. The cycle feeds on itself. Student loan delinquencies may rise, with 1 in 3 student loan borrowers at risk of default as delinquency rates soar. Another $1.8 trillion in debt, much of it held or guaranteed by the government, but some held by private lenders and banks. When these borrowers default, it impacts their ability to service other debts. Mortgages, auto loans, credit cards, the stress spreads. Banks are modeling all of this. Their CECL models incorporate rising delinquencies, accelerating defaults, deteriorating consumer credit quality. And those models are forcing them to build reserves now for losses they expect in 2026 and beyond. The Federal Reserve's stress test is designed to ensure banks can survive a severe recession. The 2025 severely adverse scenario features a severe global recession, with the U.S. unemployment rate rising 5.9 percentage points to a peak of 10%, accompanied by declines in asset prices, including about a 33% decline in house prices and a 30% decline in commercial real estate prices. Banks passed. They all passed. Their capital ratios remained above regulatory minimums, even in this disaster scenario. This should be reassuring, but look deeper. The stress test projected an aggregate 1.8 percentage point peak-to-trough decline in Common Equity Tier 1 capital ratio, significantly smaller than the 2.8 percentage point decline in 2024. The projected impact was actually less severe than the previous year. Why? Because banks built up more capital cushion. They're preparing, building buffers, increasing reserves, not because regulators are forcing them to. The stress test says they're fine. They're doing it because their internal models, which are more detailed and specific than the Fed's generic scenarios, are telling them they need more protection. The stress test is also limited in scope. It only tests the largest banks. Current stress test eligibility requirements focus on larger institutions that tend to have smaller commercial real estate exposures, potentially understating the true risks. The regional banks most exposed to commercial real estate aren't in the stress test. They're not evaluated. They're not required to prove they can survive a severe scenario. And many of them can't. When the commercial real estate defaults cascade in 2026, regional bank failures will follow. The stress test scenarios, while severe, are also stylized. They assume gradual deterioration, unemployment rising steadily over quarters, asset prices declining in an orderly fashion. But real crises don't unfold gradually. They cascade. One failure triggers another. Panic sets in, liquidity disappears. Orderly becomes disorderly very quickly. Banks know this. They lived through 2008. They remember Bear Stearns going from adequately capitalized to bankrupt in days. They remember Lehman Brothers failing overnight. They know the stress test scenarios, while useful, don't capture the dynamics of actual financial crises. So they prepare beyond what the stress test requires. They build extra reserves. They maintain higher capital ratios. They reduce exposure to risky sectors. Not because they're required to, because they're scared. There's a phenomenon banks don't talk about publicly. The slow migration of deposits from regional banks to large banks. It's been happening since the 2023 failures, and it's accelerating. When Silicon Valley Bank failed, depositors at other regional banks started asking questions. Is my bank safe? Is my money insured? Should I move my deposits to JPMorgan or Bank of America just to be safe? The FDIC insures deposits up to $250,000. But many businesses, nonprofits, and wealthy individuals have deposits exceeding that limit. At SVB, over 90% of deposits were uninsured. When the bank failed, those depositors initially faced the prospect of losing everything above $250,000. The government stepped in, made all SVB depositors whole, even those with uninsured deposits. But the message was clear. If your bank fails, your uninsured deposits are at risk. And the government might not always bail you out. The rational response? Move money to banks that are too big to fail. JPMorgan, Bank of America, Citigroup, Wells Fargo. Banks so systemically important that the government will never let them collapse. Your deposits might not be technically insured above $250,000, but they're implicitly guaranteed. This migration of deposits is a slow-motion bank run. Not a panic rush to withdraw cash, just a gradual, rational reallocation of deposits from regional banks to large banks. But the effect is the same. Regional banks lose deposits. With fewer deposits, they can make fewer loans. With fewer loans, they earn less interest income. With less income, they have less capital to absorb losses. And when commercial real estate loans start defaulting, these regional banks will have less capacity to survive. The deposit migration that's happening now makes the 2026 crisis worse. Banks don't just look at their own loan portfolios. They analyze macroeconomic conditions, economic growth, unemployment, interest rates, inflation. These factors drive loan performance. Right now, the macroeconomic indicators are flashing warning signs. Deloitte forecasts that after modest gains in 2025, the consumer price index may hover at roughly 3.2% in 2026, with the Federal Reserve potentially dropping interest rates to 3.125% by the end of 2026 due to a weakening job market. Why would the Fed cut rates dramatically? Only one reason. The economy is weakening significantly. Unemployment is rising. Recession is here or imminent. The Fed doesn't cut rates by 2 full percentage points in a year unless something is seriously wrong. Banks see this coming. Their economists are analyzing the data. Yield curve behavior, leading indicators, consumer spending trends, business investment patterns, all pointing toward recession in 2026. JPMorgan's chief financial officer has indicated the bank's central case sees a mild recession with unemployment peaking at just under 5%, while Bank of America's CEO expects unemployment to peak at about 5.5%. and remain above 5% through the end of 2024. These are the public statements. Conservative estimates designed not to panic markets. The internal models, the ones driving reserve builds and capital planning, likely assume worse outcomes, because banks have to prepare for adverse scenarios, not base cases. When unemployment rises from 4% to 5.5%, that's a 37.5% increase in the unemployment rate. Millions of people lose jobs. Consumer spending falls, credit card delinquencies spike. Auto loan defaults rise, mortgages go delinquent. The entire credit portfolio deteriorates. And banks have to reserve for this now, under CECL, based on their expectations. That's why reserves are growing, even though current delinquency rates remain relatively low. Banks aren't reserving for today. They're reserving for 2026 and 2027. Look at the actions, not the words. Banks are building reserves aggressively, setting aside billions for loan losses despite currently low default rates. This only makes sense if they expect significant deterioration ahead. Reducing commercial real estate exposure, not making new CRE loans, tightening underwriting standards, trying to reduce concentration before the crisis hits. Banks that can exit problematic exposures are doing so, hoarding cash, maintaining higher liquidity ratios, not deploying all available capital into lending, keeping powder dry for when opportunities emerge during the crisis, increasing capital ratios beyond what regulators require, building buffers that exceed stress test minimums. This costs money. It reduces return on equity. They're doing it anyway because survival matters more than profits. Preparing contingency plans. Every major bank has a crisis playbook. Procedures for if deposit runs accelerate. Plans for if correspondent banks fail. Strategies for accessing Federal Reserve emergency lending facilities. These plans are being updated and tested. Stress testing beyond requirements. Running internal scenarios more severe than the Fed's tests. Modeling cascading failures, contagion effects. Non-linear deterioration. The scenarios they don't discuss publicly but guide their internal planning. These are the actions of institutions preparing for a severe crisis. Not positioning for a mild slowdown, preparing for potential catastrophe. The timeline. Based on the patterns banks are seeing and the preparations they're making, here's the likely timeline. Q1 2026. Commercial real estate defaults accelerate as the maturity wall hits. Office building owners increasingly default rather than refinance at prohibitive rates. Banks start recognizing significant losses on their CRE portfolios. Q2 2026, regional bank stress becomes visible. One or more regional banks with heavy CRE exposure approach capital minimums. FDIC puts them on watch lists. Deposit flight accelerates from vulnerable banks. Q3 2026, first major bank failures. One or more regional banks are seized by FDIC and sold to larger institutions. This triggers broader concern about banking system stability. Stock prices of regional banks with CRE exposure crash. Q4 2026, credit deterioration spreads beyond commercial real estate. Consumer loan defaults rise as recession deepens and unemployment climbs. Credit card charge-offs spike, auto loan delinquencies increase. The stress that started in CRE spreads throughout the banking system. This timeline isn't prediction, it's what the data suggests. It's what banks are preparing for based on their internal models and the reserve builds we can observe. What you should do. If banks are preparing for a 2026 meltdown, you should be too. Here's how. Verify your deposit insurance. FDIC coverage is $250,000 per depositor, per bank, per ownership category. If you have more than $250,000 at one institution, you're exposed. Spread deposits across multiple banks if necessary, or move excess deposits to Treasury bills, which are backed by the full faith and credit of the U.S. government. Avoid regional banks with heavy CRE exposure. Not all regional banks are at risk, but those with high concentrations of commercial real estate loans in markets with severe office vacancy are vulnerable. Regulators view CRE exposure ratios over 300% as excessive. You can research your bank's CRE concentration through publicly available call reports. Maintain emergency liquidity. If bank failures or financial system stress intensifies, access to credit will tighten. Credit cards might be cut. Home equity lines could be frozen. Have 6 to 12 months of expenses in liquid, safe assets. Cash and insured accounts or treasury bills. Understand your mortgage situation. If you have an adjustable rate mortgage that will reset in 2026, understand your options. Can you refinance to a fixed rate now? Can you afford the payments if rates reset higher? Don't assume you'll be able to refinance during a banking crisis. Credit availability will be constrained. Review your 401k and investment accounts. Are they held at a stable, well-capitalized institution? During the 2008 crisis, some brokerage accounts were temporarily frozen. Make sure your investments are with institutions that will survive severe stress. Don't panic, but do prepare. The goal isn't to predict the exact timing or severity of the crisis. It's to position yourself so that whatever happens, you can survive and potentially benefit. Banks are preparing defensively. You should too. The uncomfortable reality: banks aren't telling you they're preparing for a 2026 meltdown because saying so would create the very panic they're trying to avoid. Confidence is everything in banking. The system runs on trust. If everyone believes banks are safe, they are safe. If everyone doubts banks, bank runs become self-fulfilling. So bank executives give reassuring interviews. They say the system is well capitalized and resilient. They point to passing stress tests. They emphasize how much stronger banks are compared to 2008. All of this is technically true. But watch what they do, not what they say. They're building reserves, reducing exposure, hoarding cash, preparing for severe scenarios. These actions reveal what they really believe is coming. The preparations don't mean catastrophe is certain. They mean it's possible, perhaps even probable. Banks are sophisticated institutions with access to better data and models than almost anyone else. When they prepare this aggressively, you should pay attention. The 2026 meltdown might not be as severe as 2008. Banking regulations are stronger, capital ratios are higher. The Fed has better tools for emergency intervention. But commercial real estate stress, consumer credit deterioration, and regional bank vulnerabilities create a toxic combination. And banks see it coming. They're preparing. You should be too. The difference between those who survive financial crises and those who get destroyed isn't luck. It's preparation. Understanding the risks before they materialize. Positioning defensively before panic hits. Having the liquidity and flexibility to weather the storm. Banks are doing all of this right now, building reserves that cost them profits. maintaining capital that reduces returns, holding liquidity that earns little interest. They're paying these costs because they believe the protection is worth it. You have the same choice. Prepare now when it's easy and costless, or wait until the crisis is obvious and it's too late. The signals are clear. The banks are warning you through their actions. The question is whether you're paying attention.